Well, President Trump downplaying recession risk despite the volatility that's rocked markets the last 3 weeks as parts of the economy begin to show cracks. Trump saying yesterday, quote, "I think the country is going to boom," and markets, quote, "don't concern me." However, our next guest says ultimately the net impact of Trump's policies on inflation will depend on whether weaker services spending outweighs higher goods prices. And in February, it's clear the disinflationary effect from softening services outweighed the uptick in goods inflation. Joining me now is Anna Wong, Bloomberg Economics chief U.S. economist and former chief international economist for the Council of Economic Advisors. Anna, you know I always love speaking with you, so thank you for making time with us this morning. I want to start on how you are thinking about the next inflation print we may be getting, which could indicate a little bit more of the inflationary impact of Trump's tariff policies.
Right. So in the next inflation print, we'll get half of March where the steel and aluminum tariffs will be in place as it came into full force today without much exemptions. And we are going to also get all these retaliation from EU and other and Canada on a whole bunch of other goods. So I think today's report kind of already gives us a flavor of what how tariffs will appear in CPI. We have seen a little bit of uptick in the prices of apparels and furnishings and things that are subjected to highly exposed to China so far. But in the next month, I think we're going to see perhaps more pressure on car prices as well. The seasonal factors for cars are not looking favorable for disinflation. So I think the story for March CPI would be that goods disinflation stalled, while services discretionary prices continue to come down as consumers pull back on spending.
Anna, what does that mean for the Fed?
Well, I think the Fed is not going to move as long as inflation expectations remain elevated. And we have seen in the inflation expectations data, there's a strong partisan divide in terms of this uptick. So I think what this means is that the Fed is going to cut only belatedly. And as a result, this tightening on financial conditions and the hurt on the real sector and the labor market will have to be far in advance before the Fed will begin to cut. This is risking a deeper downturn.
And Anna, I do just want to quickly break some news here for our audience. We have headlines coming in here that Canada's new reciprocal tariffs are going to begin at 12:01 a.m. on Thursday. Again, this continuation of the tit for tat between the U.S. and Canada. You're looking at a live shot there of a Canadian official speaking about Canada's retaliatory efforts off the back of those increased steel and aluminum tariffs. Anna, going back to you on this, I think this is indicative of part of what the market is struggling with right now, that this tit for tat for tariffs, it's unclear where and if it ends. How do you think that that impacts the economy? Do you think that that continues to lead to any slowness that could result in a recession?
Oh, so yeah, definitely retaliation by our foreign trade partner will show up as weaker economic activity in the U.S. For example, Canada's retaliation will disproportionately hurt U.S. Manufacturers. And later in the month, the EU also is about to reinstate a very large tariffs on U.S. bourbon, which will disproportionately hit Kentucky and the district under Mitch McConnell. So I think that all that will mean softer economic activities, and this is why I expect more pullback in discretionary services spending, which ultimately will be disinflationary. So in terms of recession, this R word, one important preconditions for recession is we have to see a widening of credit spreads of around 200 basis points. And so far, we are maybe a quarter. We've seen maybe less than a quarter of that. And in order for credit spreads to really widen, you need to see more panic in the stock market, a bigger sell-off in the stock market. And I think we are not there yet. So a lot of this recession talk is based on vibes, and in terms of hard data, it's not really there yet.
Well, Anna, it's a great breakdown, but to your point, we have seen a little bit of that widening in credit spreads, not to the degree that you're mentioning, of course. I wonder how you're thinking about the impact of the labor market here. It seems like in the headline numbers, things continue to be okay, but there are cracks under the surface. What do you think could potentially be the breaking point for the labor market that could then hurt the broader economic picture?
Definitely. I think the good trigger would be a government shutdown this Friday. So the House has passed the bill for a funding gap bill, and it's now in the hands of Senate. And they're playing the game of chicken where it's all up to the Democrats now on whether they want to sign off on the bill. And I think the risk for a shutdown remains to be very, very elevated. And if there would be a shutdown, then that would last for another month. Then we could possibly see April's unemployment rate spike to above 4.6%.
All right, Anna, also, I lastly want to end with you just on how you're thinking about the market volatility and the selling that we are seeing as an indicator of the economy. At what point would the dip be significant enough for you to be concerned that asset prices could weigh on consumer wallets, consumer spending, and therefore the economy?
Yeah, so the sell-off will have to spread to a sustained period of elevated VIX, as well as a widening credit spreads of around 200 basis points, as I was saying. And we are not there yet. And the elevation of VIX has to be also be sustained. And until that happens, then I think this temporarily confidence decline will will bounce back after they see better hard data.
Right. All right, Anna, thank you so much for breaking it down for us and reacting to that breaking news as well coming out of Canada. We really appreciate it.